All right, brilliant. Thank you, Roland. Yeah, good evening, everyone. Thanks a lot for coming. So the first slide just gives my background. I won't spend too long here, but tonight I'm going to be talking about the Fidelity Emerging Market Trust that I manage with my colleague Nick Price. So I've been at Fidelity for around about 15 years. I joined as an analyst covering a number of different sectors, industrials, commodities, metals and mining. I did a shorting role for a number of years before transitioning onto the portfolio management team. Nick's been around almost twice as long as I have, coming up to sort of 28 years at Fidelity, and we manage the Emerging Market Trust together. Okay, so this slide gives a bit of an overview of the trust and how it differs a little bit from a more traditional sort of long-only product. And so I'll start off with the chart on the right-hand side. A traditional fund or a traditional investment trust, if you invest $100, typically that trust would invest into $100 of assets. And what we do in the Emerging Market Limited Trust is we extend that long book to 130, and we also have a short book against that of around about 30% as well. And so for every $100 you invest in the trust, there's about 160 of sort of active exposure working for you. And particularly in emerging markets, there's a lot of phenomenal businesses, but there are also some very bad businesses out there. And with this product, we're able to sort of benefit from shorting some of those bad businesses that are run by unaligned management teams, where there might be corporate governance concerns, that sort of thing. In the sort of the core long strategy, what we're trying to identify is high quality, long-term compounders. We define quality as a business that's able to generate returns on invested capital above their competitors. And so we're very much sector agnostic. We'll look across all different sectors. You can find a quality mining business or an oil and gas producer if the assets are at the bottom of the cost curve and they're able to generate high levels of return. So we define that sort of quality framework, and we're willing to invest across all sectors. In the short book, we're looking to identify structural losers. So this might be a fraud. It might be a company where the management team is siphoning cash out of the business. It might be one where there are sort of undisclosed regulatory risks. And so we're looking to identify these failing businesses in the short book. And then we also make use of pair trades. I'll give an example there later in the presentation. And finally, we have around about 175 analysts at Fidelity, and so a huge research team available to us, and that enables us to go sort of right down the market cap spectrum, particularly in an investment trust, a closed-ended product where liquidity is less of a concern. We're willing to invest in small caps where we see sort of some of the most exciting growth opportunities in emerging markets. So the next slide gives a bit of a sort of a snapshot on emerging market valuations, and I'll talk a bit about why emerging markets today. And so the chart on the left-hand side, the orange line shows the sort of the valuation of the United States, and the blue line shows the emerging market sort of PE multiple as well, which is on around about 12 times earnings versus north of 20 times for the US. And that gap has expanded over recent years, and the discount that EM trades at today is at multi-decade highs, almost 40% today. I think one of the main reasons it expanded so much in recent years, if you look at what happened during COVID, the US government and developed markets around the world used their sort of fiscal toolbox to help out the consumer. And particularly in the US, the government racked up massive sort of fiscal deficits. And so you've seen that money flow to the consumer's pocket and into the stock market. Whereas you're seeing the exact opposite in emerging markets. The most important emerging market is China. And China was going sort of very much down another path of tightening, specifically related to the property sector. So you had a massive bubble in the property market in China 5 years ago, and the government tried to deflate that over the period from sort of 2020 to 2024. So whilst the US was running extremely sort of lax fiscal policy, you had massive tightening going on in the most important emerging market in China, and that put a huge dampener on consumer sentiment in EM generally. And so that discount has widened. I think what we're seeing today is a bit of a reversal of that. So in the US, you're seeing austerity, famously with Doge and Elon Musk, but the US is starting to cut costs and trying to address that sort of unsustainable fiscal imbalance. And the opposite is happening in emerging markets. China has pivoted to reflating the economy. They've achieved what they wanted to in the housing market, and they're starting to cut interest rates and try and drive consumption again. And so I think those forces that drove that derating of EM from 2021 to 2024 are reversing today. And the other thing I'd mention is there's huge dichotomy in emerging markets as well. And so whilst the market on the whole is cheap, there are certain countries that screen as quite expensive today, the likes of India and Taiwan in particular. And then there are some markets that are extremely cheap relative to history. And so down at the bottom, you've got countries like Brazil and Mexico that are trading at multiples we've never seen before in terms of how cheap they are. And so it's very important to have active exposure within EM. And so, yeah, I'll go through a few examples. China, as mentioned, is, I think one of the most important drivers for emerging markets. And it's interesting that you're seeing these huge, enormous tariffs put onto China, which, the headlines are quite frightening. But if you look at the total sum of the gross exports of China to the US, it's around about $400 billion, which is about 2% of GDP. So it's a manageable impact for China, even if it goes to zero. The pain that will be inflicted on the US from these tariffs is going to far outweigh any pain that's inflicted on China, and China is much more patient. So I think when you're starting to see inventories draw down in the US, extreme levels of domestic inflation, I don't think Trump has as strong a bargaining position as China does, and we're going to see, we're already starting to see some of these tariffs being walked back, and I don't think the US has the tolerance to see shortages on the shelves and equity markets and bond markets both falling at the same time. And so I think that we're going to see some of these tariffs unwind. More importantly, what will China's response be? It's going to be domestic stimulus. They're cutting interest rates. They've started to take measures to inflate the property sector again, and that can have a meaningful impact on consumption, which has been one of the biggest problems in China over the last few years. So the chart on the left shows household savings in the blue bars versus the increase in household debt. And so since COVID, you've seen an enormous amount of excess savings built up by the household in China. And after COVID, the US and Europe, the consumer went and spent that sort of excess savings buffer that was built up. That hasn't happened in China because sentiment was so negative, particularly towards the property sector. A huge amount of household wealth in China is tied up in property, and we're starting to see early signs of a recovery. So the chart in the middle shows the month-on-month changes in various tiered cities, and the blue line is the most important one, so tier 1 cities, which is the most important in terms of value. You've started to see signs of recovery in recent months, and so this sort of top-down agenda in China to drive a recovery in consumption and support the property sector will enable the consumer to go out and spend that sort of big buffer of excess savings that's been built up over recent years. So I think the outlook for the consumer in China is very attractive for the first time in a number of years. There are problem areas in China. We have quite a negative view on banks, partly because of the interest rate cuts that you've seen coming through from the government will pressure bank net interest margins, but also on the asset quality side of things, that property sector issue has made its way onto the bank balance sheets. And so I think you've got a pretty negative outlook for banks. And then on the manufacturing side of things, you're also going to see these export curbs hurt a lot of the manufacturing industry in China. So it's very much a mixed bag, and we have almost the entirety of our China exposure in the trust in the consumer sector. And so I think whilst China markets will be mixed going forward, I think we can see very strong performance from some of the consumer-facing stocks. And we just give one stock-specific example here, a company called Full Truck Alliance, which is it's pretty much an Uber for trucks in China. And so it's a freight matching business. The trucking industry in China is incredibly fragmented, and Full Truck Alliance is a digital platform that matches these trucking businesses with the customers, the factories, and it does so at a much cheaper rate than the traditional offline market. So a traditional freight broker will take 8-10% of the value of the cost of shipping. Full Truck Alliance does it around about 1.5%. So there's a huge cost saving for customers shipping to these offline brokers that do it over the phone to a platform like Full Truck Alliance. And that take rate, I think, can go from 1.5% to 4 or 5% over the coming years. And that's a tripling of revenue that all drops down to the bottom line. And so when you are able to go into some of these smaller cap areas in China, I think there are stock-specific stories like Full Truck Alliance, which is in a monopolistic position today, and I think that will remain the case. There are some very exciting opportunities. So this slide talks a little bit about Mexico, and that was one of the examples on the valuation slide where I think we're at pretty extreme levels. And so the blue chart on the left-hand side shows the P multiple, price to book P multiple of Mexico relative to emerging markets. We're at 1.5 decade lows here, and I'm sure if we extended that chart back further, it would show a similar story. We've never been so discounted as we are today, and I think it's a little bit unfair because if you look at the tariffs that were announced by the US and who they'll impact more or less, the reciprocal tariffs, Mexico was one of the countries that came out relatively well. And so I think you're going to see a continuation of companies shifting their supply chain out of China and towards countries like Mexico. You have a decent backdrop for sort of tariff impact. Valuations at multi-decade lows. And lots of the businesses that are listed in Mexico aren't Mexican businesses at all. And so Gruma is one company that we're invested in. It's the largest tortilla maker in the world. It has a dominant position, 70-80% of the US market. And the chart on the right shows their sort of earnings breakdown. 2/3 of the business is in the US. And so it's incredibly cheap. But it trades on about 13 times earnings because it's listed in Mexico. But really, it is a US business. And so there are lots of opportunities like this to invest in Mexican businesses where all of the assets are north of the border, but the stocks are cheap just because of where the company is incorporated. Brazil is another example of one of those countries that is, it's extremely depressed in terms of valuation. So it does have a bit of a budget issue. So I mean, the chart on the left-hand side shows the orange line is the one to look at that shows the sort of fiscal deficit climbing. And so there are concerns in some emerging markets. So we shouldn't shy away from some of the negatives. But at the same time, you've got extremely low unemployment. So the orange bar in the middle chart shows the unemployment rate in Mexico. Again, the lowest it's been in multiple decades. And so you have a very strong economy, very strong GDP growth, and a market that trades on around about 7 times earnings. And importantly, you have an election coming up in about 18 months where the most likely outcome is that the incumbent government run by President Lula will be replaced by a more centre-right government, the leading candidate being a guy called Tarcísio. And so you're going to have political change, which will address some of those fiscal issues that are shown on the sort of left-hand side. And so again, it's an emerging market that is trading at valuation levels that we've never seen before, and that creates a lot of opportunity. A bit closer to home. Again, this paints an example of what I was saying about investing further down the market cap spectrum. And TBC Bank, which is actually listed in the UK, it's one of the leading banks in Georgia. So there are 2 banks, Bank of Georgia and TBC. This is a company that trades on about 0.6, 0.7 times book. It has consistently generated returns on equity in the mid to high 20s, which you see on the right-hand side there. And that will continue. It's a duopoly banking system. There's very limited competition. And so 0.6, 0.7 times book, high 20s ROE means you're paying around about 5 or 6 times earnings for this business. And it's paying out a large amount of those earnings in dividends. Not only that, but there's huge optionality from them expanding into the neighboring Uzbekistan, which has almost double the population of Kazakhstan. And the guy who's leading that expansion, a guy called Oliver Hughes, is one of the best banking CEOs in the world. He built Tinkoff Systems in Russia. And so I've quite high confidence that they can replicate the success that they've had in Georgia, in Uzbekistan. Onto commodities. And so we've got a decent amount of gold exposure in the fund, just over 10% of the fund. And so here, the chart on the left-hand side shows the gold price in orange, which has obviously recently hit all-time highs. But there are lots of gold miners out there that are very overlooked, and we give one example here of Buenaventura. Historically, it's been more of a copper miner, but over recent years, the new production they've brought in online has been in gold and silver, and so it's transitioned from predominantly a copper mining business into a gold miner, and it's actually underperformed the Peruvian market over the last few years. Despite the fact that it's had incredible operational performance, they've upgraded their sort of production guidance. They just had results today, which were very strong, and so it's been a huge laggard versus the gold price. And so you might think the gold price has gone up so much, these miners must have all kept pace, but that's not been the case at all. And so there are various sort of gold miners out there that we find incredibly attractive. Many of them at spot sort of gold prices are generating free cash flow yields well above 20%. And so we think there's a long way to go for gold miners if the gold price stays where it is today. But I think there are various reasons to be positive on the outlook for gold, specifically given what's going on in the US today. I think the US and treasuries are losing their sort of reserve status to some extent, and central banks are looking for an alternative. And that's been happening since Russia's assets were confiscated after the invasion of the Ukraine. Next slide. So on that pair trade comment, so as I mentioned earlier, this fund will look to invest its long book in structural winners, but there will obviously be structural losers as well. And so Cattle is a core holding in the long book. It is the leading battery maker in the world. It has around about a 40% market share globally of automotive batteries. They invest more in R&D than all of their competitors combined, and it's turning into a monopoly duopoly with a number of different casualties. Most notably, the Korean battery chain has got way too much debt. So all of these companies in Korea were sort of had their R&D debt financed and having to cut R&D now, and the balance sheets are all broken. And these companies are all on their way to sort of bankruptcy. And so in an area like automotive batteries, there's a way to profit on the long side by investing in a winner like Cattle, but also by benefiting in the short book as well by shorting some of the companies that are being disrupted. I mean, I won't spend too long on these slides because this gives a bit of a snapshot on how we're positioned sort of sector-wise and on the next page country-wise. We've got big overweights in financials. It's an area where we see a huge amount of value, particularly in India. So India, as I mentioned, is an expensive market. The one area that we do find particularly attractive in India is some of the Indian banks today. But generally, like the likes of TBC that I mentioned, there are some extremely sort of cheap oligopoly businesses dotted around emerging markets, and financials is an area where we see a lot of attractive stock opportunities, and in the fintech space as well. So companies like Nubank and Banca Inter in Brazil and Kaspi in Kazakhstan are fantastic opportunities as well. The overweight in consumer discretionary relates to what I was talking about in China earlier. So almost all of our exposure in China is in consumer because that's where I see the sort of upside from the stimulus measures being taken. And the next biggest overweight is in materials, and that entire materials position is in copper, where there are phenomenal sort of tailwinds from grid investment globally, but also no new supply coming online for the foreseeable future, and as mentioned in gold as well. And then towards the negative end of the spectrum would be some of the areas like utilities and fixed line telcos, where in emerging markets these are seen as sort of piggy banks for governments, and whenever they generate excess returns, they're taxed away by governments. So those are sectors where we struggle to find ideas that fit in with our investment philosophy. And then country-wise, the big overweights are South Africa. A big chunk of that is Naspers, which is a holding company for Tencent, so you can think of it as a bit of China exposure in there. But SA is a country that's had huge sort of positive political change. And it's an economy that's seen underinvestment for ever since they hosted the World Cup. And so I think that positive sort of change in government can be a sort of catalyst for spending again amongst corporates. And then some of the other countries, Mexico and Brazil, as mentioned, extremely cheap and winners in a world of higher tariffs, and Kazakhstan, where the majority of the exposure is Kaspi. On the negative side of things, you've got the likes of Taiwan, South Korea, more expensive markets that are losers from the tariff announcements. And so I think there's a lot of phenomenal businesses in Taiwan, and so it is an area where we do have a decent amount of exposure, just not as much as the index. And so, yeah, I think you have to be very careful when you're investing in some of these Asian countries, given the tariffs are sort of here to stay, I think. And then India, we're more or less balanced. I think it's a market that's got phenomenal long-term demographic tailwinds, lots of fantastic businesses, but the valuations are a bit expensive, and so some sectors are more challenging to invest in. And then finally on performance, so this goes back 5 years. We've been running this trust for just over 3 years, and so positive performance relative to the market over that 3-year time frame, and particularly over the last 6 months. It's been strong period of performance for the trust relative to the EM benchmark, and this goes up until the end of March, and April's been a very strong month as well. We're sort of quite well positioned for what's going on with the US tariff announcements, given that sort of Latin America exposure. And I think that might be the last slide. So, Okay. Happy to take any questions.
Thank you. Okay, as I said, if you have a question, please raise your hand and wait for my colleague to come over the microphone at the back there, please, Steve.
Is this intended to be a capital growth fund or income fund?
Yeah, I think if you were to look at I'll focus on the long book. Very, very much sort of capital growth. So it does pay a dividend, which is more or less in line with the market sort of dividend of emerging markets, about 2%. But that sort of investment philosophy around companies that are generating high levels of return. Typically, these businesses will have the opportunity to reinvest at those high levels of return, and so we do have a growth bias in the portfolio. And so, I would say it's much more on the capital growth rather than the income side of things.
Other questions? Question down the front here, please, Steve. Thank you.
Thank you. You've spoken about your interest in Chinese consumption story. I mean, on the basis of recent geopolitical events and particularly tariffs, has this motivated you to reorient a little bit out of export-driven companies and reorient more towards domestic consumption, or has it not really made a difference to strategy and you're basically riding through current events, with the strategy you have?
I think going into the announcements, we were quite cautious as to what would what the tariff levels would be that were imposed on China. So we were very sceptical of Chinese exporters. If we were to have this conversation 6 months ago, I think if you could take a whole number of different industries, whether it's automotives, whether it's steel, whether it's petrochemicals, China has created a huge amount of excess capacity in a number of different industries and is exporting that to the rest of the world. And so even without the tariffs, the backdrop for these businesses was pretty bleak. So we haven't really changed our positioning in that regard because we didn't have exposure to these businesses to begin with. I would be very cautious on companies like Shein or Temu, which is owned by PDD, which are selling cheap crap to the US consumer. I think these businesses have got an existential problem. And we don't have any exposure there.
Other questions for Chris? Otherwise, I had a couple. Could you explain proportionally the short book versus the long book, where you get more performance?
Yeah. So in the last few years, the short book has been a very big contributor to performance. And I think that's been because we sort of live in quite volatile times. And so, the most common feature of the short book is high levels of debt. And so typically on the long side, if a company is generating huge returns on capital, they don't need to use their balance sheet to grow. For the short book, these are businesses that are burning cash. They've all got huge amounts of financial leverage, and we've seen high interest rates over recent years relative to the sort of ZERP era, and a lot of these businesses have finally been able to not been able to roll that debt, and so a lot of these companies have fallen as a result of their capital structure. And so the short book's been a huge driver for performance, as has the mid cap exposure in the long book has been very helpful as well. And so and that speaks to that sort of research team that we have at Fidelity, 170 odd analysts looking for these smaller cap ideas, and that's where most of the sort of uncovered gems are.
Thank you, Steve.
I was interested in the chart you had showing the sectors you were in and how they'd changed, and noted that there was quite a significant change in financials, as I remember, on the left-hand side, which caused me to question for a moment if you might comment on the level of turnover within your investments, and give an indication maybe of the average time that you hold in your investments.
Yeah, so it will be a different answer for sort of the name turnover versus the trading turnover, because we do have the short book that will have much higher turnover than the long book. If I were to speak to our long only strategy, the turnover is typically about 70%.
Sorry,
70 per annum. But the turnover of names is much lower, and so there's a number of different holdings. NASPA's would be a good example. Grupo Mexico in Mexico. They're businesses that we've owned for well over a decade, and so a lot of that turnover will be the stock is sort of has done well and starting to look a little bit expensive, and we'll start to reduce the position and reallocate to something that's underperformed. And so the name turnover is much lower than that. And then the other question was on the financials exposure, why that's increased. I think a lot of it is so it's been adding to India a little bit, and so we've recently been adding to some of the Indian financials, and it's one of the I think one of the countries that will do well given the sort of backdrop that we've seen this year. And so you also saw the Indian market sort of sell off at the end of last year, and so that offered us an opportunity to add some exposure to the Indian banks.
Thank you.
Time for one more if anyone has a final question, otherwise I've got one. Often, I think in many investors' mind, emerging markets has been synonymous with Asia, and people haven't looked much beyond the Asian markets for exciting stories. And in your presentation, you had Mexico, Brazil, Georgia. Looking at the next 3-5 years, where are you most excited about? Which countries or regions do you think offer the most potential return?
I think Brazil is going. Brazil, it's an extremely volatile market. So if you look at what happened after Dilma left government in around about 2015, the Brazilian entire equity market went up over 200% in dollars over the next year and a half, 2 years. And that was from a starting point of around about 11, 12 times earnings. And today the market's on 7 times earnings. So it's a much more depressed starting point. And it could be a much more powerful change in government as well if you do have someone who's even worse than Lula and even worse than Dilma and Lula being replaced by someone like Tarcísio. The upside would just be enormous. And so I think, Brazil is extremely exciting, but it's obviously quite binary because it's dependent on an election that takes place in September, October next year. So I think Brazil is extremely interesting. I do think, even though we are underweight Taiwan, I think it's going to be one of the most important markets in the world. A lot of what's fueled the rally in the US has been AI, and the likes of NVIDIA wouldn't exist without Taiwan. The entire semiconductor manufacturing chain sits in Taiwan with Taiwanese companies, and so there's going to be a number of enormous winners in Taiwan. if you believe in the AI story as well. And so, yeah, I think Taiwan's another one where it's an expensive market, but there are going to be some huge winners in years to come.
Lovely. Chris, thank you very much indeed. Thank you for coming
Cheers.
tonight.
Thank you.